Something of this nature. So what a rule of thumb, right? When we're looking at maybe, for example, a rejection, or even if this rejection was in the form of, let's just say, for example, like a pin bar or something of this nature, no matter what the rejection looks like, there's something that we can do to determine the momentum. Where is the momentum in this candlestick structure or in this pattern? So what we want to do is we want to divide our candlestick, whichever candlestick we're looking at, we want to divide it in half. So already I have my Fibonacci's already kind of got the 50%. So for example, if you're looking at this pin bar over here, from the high to the low of the candlestick, we can see where's halfway. Now, as a rule of thumb, if our candlestick closes in the bottom half of this candle, no matter what color it is, whether it's red, whether it's green, whether it's purple or brown, if it closes within the bottom half of the full range of the candlestick itself, that shows us that there's more selling pressure than there is buying pressure. If our candlestick closes within the top half, then it shows more buying pressure than there is selling pressure. We can also further divide our next half. So we have a top half and we have a bottom half, and we can further divide our top half and our bottom half into quarters. So now we basically have 4 quarters of a candlestick, and we can assume that any candlestick that closes, no matter what, how big it is, if it closes within this bottom quarter, that is, you can consider that to be extreme selling pressure. If it closes within this top quarter, yes, it is selling pressure, but not so much. If it closes within this top quarter, it's extreme buying pressure. And if it closes within this third quarter, which is just above the half, then it's, yes, buying pressure, but not so much. So you more or less want to see the momentum of this candlestick structure. Now, same thing when it comes to, like, for example, this shooting star or this engulfing or this whatever, what I want to pay attention to is maybe not so much the size of the candlestick, because yes, the size does really matter. But if you're on a lower time frame, the only difference that the size of how big, maybe, for example, this candlestick forms, the only difference that's going to make for you as a trader is it's going to increase your stop loss size, because remember, your stop loss is going to be above your level of structure, and you're waiting for this candlestick to close. So the only difference it's going to make for you is just your stop loss size, and the fact that, yes, the momentum came in and there's a lot more momentum maybe than you thought there was going to be. So what I would generally want to do when I find these structures is I want to focus on the highs and the lows of the candlesticks. To me, a bearish engulfing candlestick is a candlestick that closes below the low of this previous candlestick. So I'm not even considering, yes, I know that this whole structure is called a morning star or whatever the case is, but for me, the real focus is just that I'm seeing a rejection from whatever level of resistance, maybe we're at resistance. I'm seeing a rejection from this level of resistance in the form of some sort of a wick. And I'm also seeing momentum moving away from this level of resistance because we are seeing prices closing below the previous candlesticks. So that's more or less what I'm looking at. I'm not really looking at the names, the whatevers. When it comes to candlesticks and the confirmations, all I want to see is just a rejection from a level of structure, whether that's my resistance, whether that's my trend line, whether that's my right of my double bottom structure, regardless of what, a level of structure, I want to see this rejection from that level of structure. So, or at least a wick. And then in addition, what I want to see is a bearish or a bullish engulfing candlestick, because what that shows me, for example, if we're at resistance and we're waiting for a bearish engulfing candlestick, that shows us that there's momentum that is moving away from this level of structure. So sellers are able to push prices and close that candlestick below wherever this previous candlestick opened. Sorry, someone is just phoning me. That's very rude of someone to phone during working hours. But nonetheless, let's delete all of this stuff here. Let me just make sure that I don't lose track of our process. Okay, cool. So when it comes to candlesticks and just all that you want to see with the candlestick structures, no matter what candlestick structure it is, even, for example, maybe if it was some sort of a, people call these tweezer tops or whatever the case is, when there's 2 candlesticks and then there's like 2 wicks at the top, no matter what it is, all we're looking for is we want to see, first of all, the rejection from our level of structure in the form of these wicks. And then we want to see momentum shifting away from the structure in the form of a candlestick that shows us downward pressure. So more often than not, it's going to be some candlestick, some bearish engulfing candlestick. So how are you with the candlesticks? And in terms of just generally entering, because I want to simplify it for you. I want to get the names out of your head, and I just want your eyes to focus on what are you looking for? What's the nature of what you're looking for? You're looking for those.
I understand.
Mm-hmm.
I understand because when I was going through the modules, like in module 2, I watched a video exactly like this other candlestick that you just explained.
Yeah.
And it's exactly the same, just that I did not understand from the video. So now I just got more clarity.
100%, 100%. Awesome. I'm happy because that's it. It's going to be a nice segue into our entry styles. So when we're talking about entries, let me just undo all of the stuff here that we've been drawing. When we're talking about entries, there's basically two types of entries that we can take. There's either a risk entry. Have you heard of these?
Yes, I have.
Or a reduced risk entry. So from the risk entry and the reduced risk entry, is there something that you don't understand about it before I re-explain something that you're already familiar with? Or tell me what you already know about the risk entry and the reduced risk entry.
Okay, so with the risk entry and the reduced risk entry, I just had an idea. I'm not really sure of whether it's like the right thing or not. But let's say, for example, we have what's this thing called? A rising wage, right? And then the price breaks down to the downside with an impulsive candlestick, right? So I would place a trade at the week of the first impulsive candlestick to the downside, and then set my stop loss within 50 pips of the candlestick. So what I want to know is, like, with that impulsive candlestick, does it mean is it a risk entry, or it is a more of a reduced risk entry? That's like the most confusing part, because most of the trades that I get while I was backtesting German 13 US 30, most of the trades I will get is like them breaking structure with like impulsive candlesticks.
All right. So I like the example that you've given us. So the main difference between a risk entry and a reduced risk entry is not so much got to do with the candlesticks and your entry, but it's got more to do with what is price doing when you are going to enter the market. So it's dealing more with us focusing on the nature of the structure and what's happening within the structure that determines whether we're taking a risk entry or a reduced risk entry. So to put it in nice English, in nicer English that you can understand, we're basically looking at levels of structure, right? So we know that, for example, maybe this is our support structure. So we have this ascending wedge or whatever, and we have this previous support structure that was formed before market came up and broke this resistance and gave us our third touch, right? So for us, if we were looking, maybe if this was our 15-minute chart and this is our entry time frame, and we're looking at this structure here to enter, we know that we would normally look to enter maybe at this third touch of our structure here. This to us is going to be considered a risk entry. And the reason why it's a risk entry is because price has not broken any support structure in the direction that we're looking to trade, because we're looking to sell. Price hasn't broken. Remember, when we normally taught to trade with the trend. And so for us to see a downtrend starting to form is us trying to trade with the direction of the trend on our entry time frame. So that's basically what separates a risk entry from a reduced risk entry, is because a risk entry is an entry that we take before price has broken structure in the direction that we're looking to trade. And obviously, after we've seen prices breaking this support, any entry that we get after prices have broken the support, whether it's a retest or even if prices don't really retest that previous area, but they start to correct up, as long as price, or rather, once we've seen prices breaking our support structures, we're not expecting price to come back and break this resistance area, because now we're anticipating maybe we started a downtrend. So in a downtrend, we're expecting lower lows and lower highs to form. So a risk entry is an entry that we take before price has broken any structure in the direction we're looking to trade, and reduced risk is any entry that we take after price has broken structure in that direction we're looking to trade. That's basically the main two differences. Now, to talk about our styles of entry, basically we'll have to revolve around these two types of entries. So how will we know when to take a risk entry and when to take a reduced risk entry. This example that you gave us right here is the perfect example of when to take a risk entry, because maybe you might find out that this is our entry time frame. Maybe let's just say the 15-minute. You might find out that on the 1 hour, we're at a 1 hour resistance. And so what's the nature of price telling us here on a 15-minute on the entry time frame that we're trying to trade? It's basically showing us that prices are slowing down as we're coming to that area where we're looking to sell. So it's a good kind of a confirmation that, okay, when I see prices slowing down where I want to sell, that's giving me an indication that I can look for a risk entry. Because as much as, yes, that is a higher risk entry, price is kind of, I guess, equalizing my risk by showing me already confirmation that price is slowing down as we're going to an area where I want to sell. Because as much as this is slowing down, it's still an uptrend because price is still creating higher highs and higher lows within this ascending structure. It's just the nature of how this ascending structure is forming that we know that momentum is slowing down or dying out. But on the other hand, if price had a lot of momentum coming straight into this area of resistance where we're looking to sell, because we're seeing so many buyers in this market and we want to do the opposite, we need to wait for all of those buyers to exit the market. And the only way we know that those buyers have exited the market is when sellers show themselves and are able to push prices below this previous swing low. Why below the swing low? Is because this swing low is an area where we saw buyers buying from. That means that if this market is a buyer's market, means buyers found some value at this price. Because remember, on our charts here on our right hand side is the price level, at the bottom is the time, how long it takes for price to move a certain amount of price pips or whatever the case is. So people are making decisions based off what's happening on the right hand side of price. So when we see, like, for example, a support being formed here, we know that at this price or somewhere around this price region, buyers saw value. To whichever buyers jumped in there, they thought that prices were relatively cheap. That's why they decided to buy. And so if sellers are able to break support structures, it means that there are more sellers than the amount of buyers, all the amount of buyers that saw value in this area, even though they were able to break resistance areas. Whoever these new sellers are that came into the market, there's a lot more of them because they're able to overwhelm whichever buy orders are sitting at the support structure, and they're able to break support and push prices lower. So that's basically, I guess, when we're talking about our entry styles, that's kind of what we wanna concentrate on. It's just basically our risk entries or our reduced risk entries. Where are we entering? Are we entering after we've got confirmation that price is moving in our direction, or are we entering before price has given us that added confirmation that we're moving in our direction?
Okay, thank you. I understand that now.
Awesome. So I like what we have on the charts now, because it's going to be a very nice segue into this pattern separation and patterns within patterns. And this is probably, I think, if you're going to concentrate on one thing in your trading career, this is probably that one thing that you want to concentrate on, because what this allows you to do is it kind of it allows you to put a much more detailed story together, because you're looking at higher time frames and you're also looking at lower time frames. And that pattern, that whole pattern separation, or looking for patterns within patterns, is you kind of just making an overall story about what's happening on the different time scales. So to give you let's do this 1 second. Let's actually just delete all of this stuff here. To give you a hypothetical example on how we're going to identify patterns within patterns. And I more so like to do these theoretical examples rather than looking at the charts, because looking at the charts, I'm showing you how one young lady does her things, like how Aussie Cat does her things, but every pair is different. So it's always better for us to rather go over the theoretical aspect, because the way that the market is going to show you these structures is going to differ depending on what pair it is. So to go into, basically, we'll use the same ascending structure. All we're looking for is for confirmations on the time frames. So to speak about our time frames, I'm going to speak about this time frame story from, I would say, a swing trading perspective. So for me, the way that I'm trading, I'm looking at maybe the daily to find a directional bias as to which direction I want to trade. Then I'm looking at maybe the 4 hour to determine important key areas where I can trade this daily directional bias. And then I have maybe, I'll just put an M here for the minute time frame. So I'll say the 1 hour and the minute time frames, the 15-minute, the whatever. This is my lowest time frame. So my low time frame just for entries. So what we're doing is, once we found a directional bias, on our 4 hour, we're going to observe structure and try and maybe trade some structure with this directional bias. So let's use the same example and maybe just, or let's just say we have a descending structure now. So we have some sort of a descending structure on the 4 hour, which is our time frame where we're looking for these trading opportunities, where we want to sell from, where we want to sell or where we want to buy. So we've observed this descending structure. We can see that, okay, first area, because we're looking to buy, maybe because it's the descending structure, maybe even momentum is probably to the upside. Maybe let's just say we're looking to buy. Because we're looking to buy, the two key areas for us to buy from is from our support areas. The first support is our horizontal support. So this horizontal support area there. Our second area is the support trend line. So if prices don't manage, or if prices manage to break below this support resistance here, because we already have a directional bias, we know we're not interested in selling. We're only focusing on buying. So where can we buy from? And that's the information that we're getting from this 4 hour time frame. So what we're doing by separating patterns is observing patterns on different time scale, on different time frames that are confirming the same direction. So for example, maybe you could find out that yes, on the 4 hour, we're waiting for our support structure to terminate there or wherever the case is. But if we went down, let me just do this. Let's zoom into this chart just a little bit more. There we go. But if we went down onto the time frame, and this is now our lower time frame, our entry time frame. So we'd still be able to see obviously our bigger overall structure because our analysis is still there. 4 hour analysis is still on the chart when we're dropping down maybe to the 1 hour. But on the 1 hour, what's the 1 hour gifting us? The 1 hour is gifting us with detail. When we're dropping down the time frames, we are sacrificing value for detail. So the higher the time frames we're looking at, whatever we're looking at, the more value we're getting. But the moment we drop down the time frames, we're sacrificing that value for detail. So you'll see that maybe on a 4 hour, we have something that looks like, or we have some candlestick structures that just push down. But if we went down maybe onto a 15-minute, we'd see a lot more detail as to how was market pushing down. And so that's what we're trying to do. When we drop down onto a lower time frame, we're trying to find a structure that complements our higher time frame bias. Because we're bullish, we're looking for structures that maybe are descending in nature. So you'll find out that maybe price looks like it's going to bounce from this area, but fails to maybe break above this high. What can we then do after that? Maybe price will give us the opportunity to isolate a nice corrective structure. Let's do a better job at drawing this example because what I'm doing now is terrible. So maybe you'll find out that from this area here, what price does is that it sort of starts to correct to the downside. And this correction here maybe might even give you confluence as to say that this is the new descending structure that I can look for those bullish opportunities for. So you're basically finding a structure that confirms this bigger structure on a smaller time frame. So you're seeing both on two different time frames, nature that is confirming momentum in a certain direction. So that's basically what our pattern separation would be. So we can even go and separate patterns even a lot further than we have. So we've already, maybe we can say on the 4 hour, we've isolated this larger descending structure. On the 1 hour, we've isolated this descending structure. Maybe we don't even want to enter on a 1 hour because maybe our stop loss is a bit too big. We want to refine our entry even further. So when we're dropping down on that 15-minute, what are we going to be finding in this small area over here? You'll find out that even on a 15-minute, in that area, price is doing something else. So we're finding patterns within patterns that are confirming this move because we know price action, is coming from the top, right? Price action is coming from the top. So you'll find out that inside this square where we're looking for our entry criteria, maybe price is also going to do something like this. And now we have multiple patterns, multiple confirmations that momentum is slowing down as we're moving to the downside. We then also maybe even have a reversal structure that shows us obviously potential for reversal. We then maybe even have a nice break of resistance areas that are showing us that lower time frames are also trending in that bullish direction that we want to trade. So we're basically adding confluences. Remember that the only reason why we're dropping down the time frames is to find a place to enter and a reason to enter. But what we're trying to do is we're trying primarily to trade our higher time frame structure. We're trying to trade this directional bias that we see on the daily, and we're trying to trade at 4-hour areas. The only reason why we're dropping below those time frames is to be able to find a reason to enter and to also be able to enter with a smaller stop loss. So that's the point of us dropping down. When we're dropping down the time frames, we're looking for information that confirms what we saw and what we wanted to do from those higher time frames.
Thank you. It makes sense because when you actually say that, it gives us, like, when you go to the like lower time frames, it gives us more reason to like enter the trade. Because when I took note of the Forex Chasers tips, when I saw that, I didn't understand it, but now that you explained it, it makes sense. Thank you so much.
100%, 100%, 100%. I think that the last thing, let's just see if anyone else joined us. No one else joined us. So that means those other 2 people were unfaithful with the session booking times and all those things.
Oh,
But
yeah,
anyway,
yeah.
just sort of tis. So I think let's go into some risk management using these indices. So
Yes.
I'm gonna simplify your process so much. Let me just undo and delete all of this because I don't want to be left with the task of, after the live session, being by myself and going back to delete and make my charts clear. So let's do this. Let's just check AJ. AJ is looking nice. Are you in this AJ buy that we sent this morning?
No, the thing is, I'm only focusing on US 30,
Okay.
Nasdaq, and German 30.
Right, no, 100%. Stick to that circle of competence. Because Mamba was even saying something yesterday that he heard one trader that he follows saying this. And he said that this trader said that if you can follow one pair, or like in your case, a couple of pairs, but the point is that you're laser focusing on a few things. If you can follow one pair every single day for 3 to 6 months, you will have learned so much more than someone that is looking at all the pairs for the past 3 or 4 years. You will have learned so much more
the
about
hard way. I learned the hard way because when I started trading last year, so I started with like all the pairs, everything. It was just like it was a disaster. But like
it's all over the place.
The more I watched YouTube videos and read, like, followed traders as well. Like, I just decided to like make my own list of the things I'm gonna trade, and it's been better. It's been better, trust me. So yeah, I feel that.
I think to round up our risk management on indices. So let me ask you this before we go into that. Which broker are you trading with?
I'm trading XM.
And what's the smallest lot size XM allows you to use?
0.1.
0.1 on indices like German 30 and US 30.
Yeah, but that's like on when you're trading an ultra low micro account. Yeah.
So normally, what's the smallest? Do you know the smallest lot size? Like if you're not trading a micro.
I don't know. I've never traded a standard account. I think I'm still skeptical about it, but scared. So I just jumped straight into the ultra low micro account.
Okay, I think when it comes to the micro, yeah, that's why I was asking you what broker you're trading with, because it does really make a difference, and different brokers calculate it in different ways. Though, so do you understand how basically a currency is calculated when you're trading currencies? Do you understand risk management on a currency?
Oh, just a bit, like, cause on the lesson on one of the modules, like, where is it? Please just give me a moment. So here it is.
Mhm.
I think I have an idea of how, but one thing that confuses me also is the perps, because in one of the let me see the module. Sorry. Oh yeah, the first module. They did give us like pairs, like which like the perps work differently.
Yeah.
With the USD JPY, it's like 0.01. And then there's the perp, but that's like the first perp, and then but with you like in euro, like the
Euro
euro and the
USD.
Australian dollar,
Mhm.
it's like 0.0001. So I don't understand like what's going on there, but the calculation
Okay.
of like yeah, you
So
can
yeah, let me clear that up for you. I know you're probably not going to use it a lot since you don't trade currencies, but I guess just for a general understanding,
yeah
let's
just
let's let's clear it up. So to calculate, so we know that like if we look here on my right hand side where all of my pairs are, where my mouse is kind of hovering is the actual price of the currency. So you'll find out that some currencies have one digit, so one digit followed by a comma and then four other digits. So some of them have five, but you'll probably see like on my trading view, the fifth digit is small. So we don't really consider that fifth digit. So after the comma, you'll find out that some pairs have four digits. So JPY pairs differ. Any pair that has JPY in it only has a number before the comma, and after the comma, we only have three digits. So when we're looking at pips, so
makes sense.
generally your pips are calculated from this first value here. So obviously, if this was maybe 0.0001 and the market moved like 2 pips, that would mean we're adding 2 on this value over here. So if we're at 0.0001 and the market moves 2 pips up, we'd then be at 0.003. So my pip values are starting here for those currencies that have 4 digits. So any currency that does not have the JPY would have 4 digits after the comma. So your pip value is like your units here, your tens here, your hundreds here, and then your thousands, obviously, there at the end. So obviously, if the market moves like 1 pip, you'd add that 1 here. If the market is moving 10 pips, this is how you'd calculate it. Your tens here, your units here. If the market's moving 100 pips, yeah, hundreds, tens, units, and then obviously 1,000 pips. But now with JPY pairs, it's slightly different. Remember, I spoke about this fifth digit that we just ignore. On the JPY pair, this last number here is that fifth digit that you can ignore. And pips really only start from here. So your units are here, and then your tens are obviously this last one here. So JPY pairs, once we get to the hundreds, then obviously we're changing this value over here. But to calculate pips on JPY pairs, if you look at NZD JPY, we can see the price is 77.511. That means it's 77.51 pips. So we're only considering the first and the second digit after the comma for JPY pairs. For any other thing, it's the third and the fourth digit that are kind of the pip values that we're concentrating on. Like AUDCHF is 0.6753. So I know that it's 53 pips up from 67.00 or 6700. So yeah, now general rule is that the JPY, not JPY, USD quote pairs. So for example, something like Euro USD with USD as the quote pair, so as the second pair. Those pairs normally have an average, or rather, if you're trading at 0.01. So now we are speaking about lot sizes as well. So if you're trading with a lot size of 0.01, that basically you trading at the value of 10 cents per pip. So you're saying that if I'm opening a trade with the lot size of 0.01 on Euro USD, for every pip that the market moves, whether in my favor or against me, I'm going to be making or losing 10 cents per pip at 0.01. Now at 0.10, if we had 0.10 here, we would then now be risking $1 per pip. And if we had one standard lot, which is 1.00, which you only see those nice big Forex gurus using, these lot sizes. If you find this lot size, then that means you are risking $10 per pip that the market moves. So when we're looking at indices now, on indices, all we're doing is timesing our values by 10. So for example, if I was trading US 30, while I'm trading a currency, I know that if I'm using 0.01, I'm risking 10 cents per pip. But because I'm now on an indice, I'm timesing by 10. So 0.01 on an indice won't be 10 cents a pip. It'll be 10 cents times 10. So which means that at 0.01 on an indice, I'm actually risking $1 per pip or per point. So what we're doing is we are converting pips to points because that's how indices are calculated in points. So your pip value at 0.01 would be 10 cents, but for an indice, it would be $1. 0.10 for a currency would be $1, but times 10 on an indice, you'd be trading at $10 per pip. Your full standard lot on a currency would be $10 per pip, but times that by 10 for an indice. If you're trading 1.00 on an indice, you're risking $100 per point.
Okay, it makes sense because I was also confused. Like when it comes to indices, we're not talking pips, we're talking points. So it was a disaster. But now it makes sense. So basically, whatever lot size that I trade in indices, I have to multiply it by 10
to get the point value. Yeah. So you know that 0.01 is 10 cents per pip. If you're trading an indice, times that by 10, and that's how much you're risking per point. Like $1 per point if I'm trading at 0.01.
Okay, now it makes sense. Thank you. Thank you so much.
But I think you see with your broker that only allows you to start at 0.10 and not 0.01. Think for your broker, because you're using a micro account. Like for example, Xness would give you both a micro account and then both a standard account. So on a standard account, your 0.01 is times 10 or whatever the case is. But on a micro account, it's exactly the same as indices. So that's probably why your broker doesn't allow you to trade with 0.01, because they want you to start risking at $1 per point. So it's like they're actually giving you an account that functions like this, like a currency, but they're not allowing you to trade at cents per point. They only allow you to start trading from $1 per point.
Okay. Okay.
Which is the same thing as using 0.01 on veracity.
Yeah.
Yeah.
Oh yeah. I'll just settle. Thank you so much. I don't think I have any other questions.
If you don't have any other questions, we're calling it a session. I think Mamba just walked in the building. That means he's done. He's done with his one-on-one session. Check him coming to stretch here.
Thank you so much. I'll book another session if I have more questions.
No problem at all. No problem at all. Thanks so much for sacrificing.
PL Morolong, I'm saying already you guys are drawing eyes of people here. What's happening now?
No, he was just explaining.
That's powerful. That's powerful. I hope you enjoyed the session. Make sure that you give this guy a review to say how did you find the session helpful to you? Were you satisfied with the answer that he gave you? Just text him and give him that review.
Okay.
Thank you so much.